Hey guys, so these are the ways where you can improve your buying power and reduce your debt to income ratio. I'm probably sending this video to you because maybe we're just trying to ransack our brains here and see what else we can come up with. There's just so many different ways of how you can possibly improve your debt to income ratio just based on what your financial situation looks like, what kind of debts that you've got, liabilities, properties, who knows. This is all I can think of. There could be even some other things I'm missing, but definitely wait till the end here. There's some really good ones at the back of this video. But there's about 5 different categories that I'll put them all in. I would say there's a product category, a debt category, rate buy downs, income, and then credit. So we're gonna start with the product category. Number 1, it's possible that if you've got to get a lower DTI to fit into qualifying for some product or some home that you want to get into, you could move to a product with a lower rate. Now, sometimes programs with a lower rate could have higher fees, and maybe that's why they have lower rates. Number 2, with the product section, you could move into a FHA or VA ARM that you could still qualify for. Maybe even a conventional one too. Number 3, you could just straight up, if you're conventional conforming, you could move into an FHA or VA that allows for a higher debt to income ratio. So this isn't necessarily reducing your debt to income ratio, it's just finding another product that has looser restrictions on DTI. And if you have really good credit on an FHA loan or good credit, it's possible you can have a DTI allowed up to 56.99%. VA loans could even be higher. They don't necessarily go by strict ratios. They more so look at a VA residual income factor, how much money you have left over at the end of the month after all your taxes are taken out, 401k takeouts, medical, all that. Another thing you can do a product, you could, if you have to pay PMI or mortgage insurance, if you don't put 20% down, you could pay that up front in a lump sum fee, or you could pay half of it up front and then pay half of it monthly instead. That's called split mortgage insurance. The last thing for product here, you could lower your sales price or lower your loan amount, bring in larger down payment. So those are the product categories. The debt, if you want to look at your debt to improve your DTI, you could potentially, if you're on a credit account with somebody, you could show that they are paying off the debt in full for the last 12 consecutive months. You can potentially get that excluded. It's called a debt exclusion. If you can show that somebody else is really paying that every month. Number 2 for debt, you could pay off debts with savings. That's hampering your debt to income ratio and raising it. Number 3, you could refinance some debt that you have out of your name into somebody else's name. I saw this happen just as early as a couple months ago. I got somebody to close by how one spouse could qualify for the loan all on her own, and we just put her car loan onto her husband's, and then boom, her debt to income ratio was lowered before closing, and they did it. The 4th thing you could do, you could pay down debt to within 10 payments. Usually, I'd say most products are going to allow you to be able to exclude that debt out of your debt to income ratio, that monthly obligation, if it's paid down within 10 payments. Some products won't. Some products make you pay it all the way off. Number 5, you could pay off your debt using 401k loan proceeds. If you take out a 401k loan, we're not going to have that payment count towards your debt to income ratio. On pretty much every product I can think about. There may be some others that wouldn't like that or make you put that into your debt to income ratio, but using your 401k is another tool that you can always use. Number 6, you could pay off debt with a HELOC. Now, maybe you already have a house, you can take out a HELOC, you're taking out new debt to pay off other debt. So, but that would only work out maybe if that other debt that you're paying off with the HELOC was really expensive, even though the HELOC would bring on new interest payments for you. Have to consider that. Number 7, you could do a debt reconsolidation. You could refinance installment or revolving debt into just maybe one big lump sum piece. I have a contact that will do that for buyers. Number 8, you could transfer your deed of another home out of said person's name for a very low amount, maybe only a couple $100 or even less than that. It's something you could do. If you got a home on your set of liabilities, then they're counting not only that loan payment, if you're on a loan payment for that, they're also counting the HOA fee, if any, the taxes and insurance against you. And that's all increasing your debt to income ratio. So if you want to get off of that, I'm not saying you can't do that. Then the next section is rate buy downs. Number 1, you can just buy points, pay more closing costs to reduce your rate. Number 2, you can get a gift, just have that be used towards points to buy down the interest rate. You could have the sellers pay for a buy down for you. You could have them in negotiations commit a certain amount of money that would go towards lowering your interest rate and payment. Number 4, it's possible, I've seen this, sorry agents, but some buyers I've seen have had their buyer agent sacrifice a little bit of their buyer commission to going towards paying for points for their own buyer. The 4th category, income. If you're self-employed, you could review your tax returns and fix add backs. It's kind of more complicated. That's something that you'd have to go do with a CPA. 2nd, it's possible you could qualify for an AMI waiver. There's some products or some conforming products there if you're a first-time buyer and you're under the area median income limit, AMI. That's where we get that term from. You can get a incentive towards your closing costs, interest rate and payment, or both. Number 4, you could omit bonus, commission, or variable income to qualify for said AMI waiver. It's possible that if you're omitting enough of that to where you can still qualify, but you're going to get under that AMI waiver threshold, then it's possible that could really save you a ton of money, and it might make sense for you. And that's a county by county thing in terms of what that area median income limit is in your county. Also, one more thing you can do, you could do something called asset dissipation. This is when somebody has a big lump sum, non-retirement account. It could be savings, it could be maybe a stock account, whatever. The underwriter will basically divide that set of money. If it's large enough, it can't just be like $5,000, but they can divide that out by 240 months or 360 months and use that as then qualifiable income for you. It's possible on some of these products to do that, but you got to have a big chunk of change, and usually you'd be sending that money towards your down payment, closing costs, or buying down your rate with that to improve your debt to income ratio, paying off other debt before you try to go this asset dissipation route anyways. 5th category is credit. Could improve your credit score to then thus improve your debt to income ratio, because if you're improving your credit score, the theory is that you're hopefully could reduce your interest rate and then payment from that. So you could do that on your own. That could take time. It could be a short, quick fix. It could be a number of different ways, but that's all the ways, guys, I can think of. Maybe one of those could work for you that we didn't even think of. And, I listed, at least 20 items there. So I'm sorry if, it wasn't one of the things that I thought about earlier, but if you think one of those would work, let me know. Let's talk about it. And I'll see you on the next video out there. Thank you.